Today we're going to talk about an investment strategy. Several of you have reached out to me, sending messages through social media saying, well, I don't know anything about investing, but I'd like to know what strategies are out there. That's why today we're going to talk about one of the best strategies, or at least one considered among the best by many people who tend to invest, especially in the stock market. This investment model is called DCA. Today we're going to explore what DCA is, how it works, and why it could be the best investment strategy for you. So let's get started right here. And of course, the most important thing, what is DCA? DCA, or dollar cost averaging, is an investment strategy that involves investing a fixed amount of money in a specific asset regularly, regardless of its price at that moment. Instead of trying to time the market by buying when prices are low and selling when they're high, DCA focuses on systematic investing. Don't worry if you haven't understood it yet. Later on, I'll give a specific example and you'll understand it better. But anyway, let's move on to the advantages of DCA. One of the main advantages of DCA is that it eliminates the need to predict market behavior. This obviously reduces the stress and anxiety associated with investing, since you won't have to worry about buying at the so-called right or perfect moment. And furthermore, by investing regularly, you can take advantage of market fluctuations to your benefit, buying more shares when prices are low and fewer when they are high. Now, let's go through a practical example so you can understand me better. Imagine you decide to invest $100 per month in an index fund. During some months, the price of the fund may be high, and in others it may be low. With DCA, you end up buying more units of the fund when the price is low and fewer units when the price is high. Over time, this can result in a lower average cost per unit than if you had tried to time the market. In other words, if you still haven't understood, let's suppose you pick a stock from the market or an ETF like the S&P 500 and invest in it. Surely if you don't know much about the market, you'll have to start researching and studying a lot about when to invest and when not to. So to avoid this, what you can do is choose a specific date or period of time. That is, invest every 15 days, invest every month, instead of, for example, if you have $1,000, investing it all in one day, you divide those same $1,000 to invest every 15 days. So depending on your investment strategy, you'll decide how much time you want to allocate to investing. So every month you invest $1,000 or $100 and so on, until you achieve that average cost. The average cost basically comes from the fact that obviously you're not going to be predicting the market value. What you'll simply be doing is investing in an asset. That asset, assuming it costs, for example, $100, next month it might be at $120, following month at $80, and based on this, an average cost is calculated, which ultimately determines the profits you end up having. Now let's move on to the psychological benefits of DCA. And it's not just limited to the monetary strategy. When investing, we know it can be a pretty stressful activity, especially when the market is volatile, and the DCA strategy helps to mitigate this stress by providing a clear and consistent structure for your investments. By knowing that you are investing a fixed amount regularly, you can stop worrying about the daily fluctuations of the market. Additionally, it also brings discipline and consistency. DCA encourages discipline and consistency, two essential qualities for long-term investment success. By following a regular investment plan, you avoid making impulsive decisions based on emotions. This can help you stay on track toward your financial goals, even when the market is volatile. You may also end up with lower investment risk. By investing small amounts of money regularly, you reduce the risk of making a large investment at an unfavorable time. This is because DCA averages out your purchase cost over time. Instead of relying on a single large purchase, this can help protect your portfolio from major losses in the event of a sudden market drop. And finally, improved long-term performance. Although DCA does not guarantee profits, you can improve your chances of long-term success by avoiding the attempt to time the market or study it in depth and stress yourself out. You focus on long-term growth and avoid the pitfalls of short-term investing. This can result in more stable and predictable returns over time. Now, what many of you have been waiting for: how to implement DCA in your investment strategy. Before moving on to this point, it's important to highlight something. DCA is not limited to stocks. You can apply this strategy to a variety of assets, including bonds, mutual funds, cryptocurrencies, and many other assets. This makes it a versatile tool for any investor, regardless of your investment preferences. So, how do you complement or implement this? First, you need to set up an investment plan. The first step to implementing DCA is to establish a clear investment plan. Decide how much money you want to invest regularly and how often. This could be weekly, monthly, or quarterly, depending on your preferences and financial goals. There is no single rule that works for everyone. Each of us has different perspectives. Next, as a second step, select the right assets. Choose the assets you want to invest in using the DCA strategy. This could include individual stocks, index funds, mutual funds, cryptocurrencies, or a combination of these. Above all, make sure to research and select assets that align with your investment goals and risk tolerance. Next, automate the process. To make implementing DCA easier, consider automating your investments. Many investment platforms and brokers offer the option to set up automatic investments, allowing you to invest a fixed amount of money in a specific asset at regular intervals without the need for manual intervention. That is, you can deposit $1,000 into your broker and set it up so that automatically every 15 days $150 are invested in a specific stock. The only thing you'll need to worry about is depositing the $1,000 each month, so the broker can take it from there and invest it without you having to do anything. Then obviously the next step would be to monitor and adjust. Although DCA is a long-term investment strategy, it's important to monitor your portfolio regularly. Review your investments periodically to make sure they're aligned with your financial goals and make adjustments if necessary. However, avoid making impulsive changes based on short-term market fluctuations, as this could have a negative impact. Finally, be patient and persistent. DCA is a strategy that requires patience and persistence. The benefits of this strategy are seen in the long term, so it's important to stay focused and not stray from the plan. Remember that long-term investments are more likely to succeed when they are based on discipline and consistency. And finally, before we say goodbye, I'd like to leave you with some case studies or examples here so you can better see how this works. Let's analyze a case study where an investor uses DCA to invest in an index fund such as the S&P 500. Suppose this investor decides to invest $200 per month over a period of 10 years. At the end of the period, let's compare the performance of the investment with the performance of the market. By averaging the purchase cost over 10 years, the investor achieves a more stable and predictable return compared to trying to time the market. Despite market fluctuations, the DCA strategy helps reduce risk and provide steady growth in the investment. However, don't get me wrong, if you have enough knowledge to time or study the market, you can use that and even compete with the DCA strategy and potentially outperform an investor who uses it. And instead of using this, you simply choose the lump sum investment strategy, where you put in a significant amount of money in a single move. But of course, this requires prior knowledge. And of course, there are many other ways to invest and many other strategies, but we can talk about those as well. For example, one of them is lump sum investing. This, unlike DCA, involves investing all your available capital at once. This strategy can be beneficial if you invest at the right time, but it also carries greater risk if the market drops after your initial investment. Another strategy is market timing investing. Market timing investing tries to take advantage of market fluctuations by buying low and selling high. Although this strategy can be lucrative if executed correctly, it is extremely difficult to accurately predict market movements, which increases the risk of significant losses. Then we have passive investing. Passive investing involves investing in funds or other vehicles that replicate the performance of a specific market or sector. This strategy aligns well with DCA since both approaches focus on long-term growth and avoid impulsive decisions based on market fluctuations. Next, we have the active investing strategy. Active investing involves the constant management of a portfolio, regularly buying and selling assets in an attempt to outperform the market. Although this strategy can offer higher returns, it carries greater risks and requires a deep understanding of the market and analytical skills. Now, let's finally talk about the advantages that DCA has over some of these strategies. DCA offers a series of advantages over other investment strategies, including risk reduction, eliminating the need to study or time the market, and promoting discipline and consistency. Although it doesn't guarantee profits, DCA can improve your chances of long-term success by focusing on systematic and long-term investing, if you'll pardon the redundancy. In summary, this strategy is powerful and can help you manage risk and promote long-term growth. By investing a fixed amount of money regularly, you can average out your purchase cost and avoid the pitfalls of trying to study and time the market every second and minute. If you've made it this far in the video, leave an emoji that represents the DCA strategy for you. It could be a little flying dollar or something green, so we know who makes it to the end of the video. That said, I'll see you next time, and I hope you've managed to understand this concept of DCA. See you! Bye-bye!